on this episode of the InsureTech Geek Podcast, talking about funding innovation with Caribou Honig from InsureTech Connect and SemperVirens. The InsureTech Geek Podcast, powered by JB Knowledge, is all about technology that's transforming and disrupting the insurance world. We'll be interviewing guests and doing deep dives into specific tech we see changing the industry. We're taking you on a journey through insurance tech, so enjoy the ride and geek out. And we are back with another lovely episode. My awesome co-host, Rob Galbraith. Rob, how's it going down in San Antonio?
It's going great, James. A little wintry weather this morning, but the sun is back outside. It's warming up, so this is a beautiful time of year to be in Texas.
Yes, it is. It was a little chilly this morning. I joined a men's workout group called F3, and we get together 3 days a week. And there's a ton of locations down in San Antonio, totally free. Nobody pays any money. We meet at 5:30 in the morning in a public park, right?
Oof.
So it looks kind of shady. It's like 20 dudes getting together in a circle and then working out like in the pitch black. It was exciting, but today it was 38 degrees or 42 degrees and rainy. So it was a bit chilly. So I am looking forward to warmer weather. With us, looking like he's ready for the warmer weather, like he's just ready for summertime. It's like that when the character from Frozen, you know, the snowman talks about in summer. You look like you're ready for summertime. So Caribou Honig. Caribou, how you doing, buddy?
I'm great, James. Thanks to you and Rob for having me here. You know, I'm probably look ready for summertime because I just got back from vacation in Belize. I was in Belize.
Nice. See, you have the glow.
I got the tan going on. Yeah, and a little sunbeam next to me here.
Yeah, exactly. A little English-speaking country just south of Mexico.
Yeah, it was actually quite lovely. I got to say, and got to do some snorkeling, and saw a couple lobsters wandering around, and they saw me, all that good stuff.
And they said, "Hey," and like I went snorkeling in Hawaii a few like 3 months ago, and I had the first time this has ever happened to me. Like multiple sea turtles came swimming, like big ones. You know, it was awesome. It's amazing, right?
Did you have them on the podcast?
I wish I could have. I did take photos of them. Wouldn't that be amazing? And wouldn't it be hilarious if it was like Finding Nemo and they're like, "Whoa, that Australian current was amazing." Dude, that sounds great. I've never been to Belize. I've always wanted to go. So I'm going to talk to you after the show, get your tips on what resort to go to, where to stay, because it's a easy flight.
I'd be happy to.
That's great.
It sounds like you might need some warm weather there.
Oh, dude, I always need warm weather. I'm a Southern boy. I was born in Louisiana. Like I was born in the heat. I was born for the heat. Rob's he's got ice in his veins. He was born, he was raised up in Michigan. They
got here since they could.
Like ice is a sport to them. Yeah, exactly. We're going to talk about funding innovation today. And I'm excited about it because we had you on a couple of years ago. So it's been a minute. And we talked a lot about InsureTech Connect, and we're gonna touch on ITC. I mean, you can't not talk about the largest conference in insurance tech. So we're gonna talk about that. We're gonna revisit the topic of how to properly spell InsureTech. And no, we're not gonna go. It's obviously more people have chosen the E than not. So it is what it is. But let's start out and just talk about your background again, because it's been a couple of years. You got a bachelor's in physics and philosophy from this little small college on the shore of a river near Boston called Harvard, next to Harvard Yard. Got an MBA from literally my favorite campus on the planet, University of Virginia, Darden School, amazing. Love the Darden School and UVA. I got to go there on a case competition when I was in college in the business school at A&M. And I was in the master's and MIS in the business school, and got to do a competition over there at UVA and loved it. Amazing. And then you went to UVA for law school for that joint JD MBA program that I'd heard so much about. So you did a really great circuit on education, and then you ended up going in to a really interesting career across communications, finance with Capital One, QED Investors. Then you hopped through some really interesting things until you kind of arrive at insurance. And so I would just like to understand what the path that led to insurance and how that's become a big part of what you do professionally.
Yeah, thanks, James. So, when you summarize it like that, it doesn't quite feel like 25, 30 years, but it's been something like that now. Look, Capital One, my formative first and only real job, sort of cutting my teeth on how to use data in business strategies. And I still remember, like, the thing which really drew me to the company at a mission level, like what it was trying to accomplish. Like, my dream as a little boy was not to go peddling credit cards, right? But when you heard the founders speak about what the mission, what the crusade of this company was, it was to transform industries through the power of information. Like, okay, that's kind of interesting. And that's especially interesting if you're, physics undergrad, geeky, that kind of way, where it's like, oh yeah, information is kind of important, kind of interesting. Also, like, I got to go through hypergrowth there. Right? 1,200 employees when I started, 20,000 when I left. Like, there was 1 year, I think it was 97 or 98. We went from 4,000 employees or 5,000 employees to 8,000 in a year. And that means with some attrition, like, basically by the end of the year, every other person who was there had less than 12 months of tenure. And I joined in like 96, so I was an old grizzled veteran by that standard. So there's so many learnings, and people talk about like the PayPal mafia and stuff like that, right? There's the Capital One diaspora. Mm-hmm. There's lots of people who've been very successful who came out of that same kind of training of it being their first and only real job. Still, it sort of grew, and eventually either I outgrew it or more likely it outgrew me. But left there in early 2006, took a little time off, watched Netflix, played with my kids, listened to the universe, reconnected with a couple other former Capital One executives, and co-founded QED Investors. We sort of didn't quite know what we were doing, but had the opportunity to learn on the job and bring some of our experience and our assets of having helped to launch and grow Capital One, and bring that to another generation, really, of entrepreneurs, not just in fintech, but in other areas, ad tech and ed tech even, and things like that. And of course, a little bit of InsureTech. I mean, people thought we knew all sorts of financial services. We didn't. We knew some, but we knew data. And of course, insurance, so data intensive. So we would get, the occasional InsureTech deal, even before InsureTech was a thing. Like, I led investment for us in a telematics company in 2011. I actually had an exit in telematics in 2015. Like, how's that for like
call that an early exit? Geez.
But and then look, 2015, 2016 smelled like something interesting was about to happen in InsureTech. And so, that led to me, okay, I'll lead the charge for the firm on what's going on there. And looking around for a good InsureTech conference, couldn't really find anything that fit the needs of what I needed to get out of it. So, necessity is the mother of invention. Luckily connected with Jay Weintraub, who knew what he was doing and actually creating a conference around this, and ended up co-founding ITC. And then that was so interesting, right? It was so much fun, much more than I thought it would be. Like, creating a conference, that can't be that interesting. Oh, no, it is social engineering at its best. Right? It's about how do you create value to hundreds or thousands or tens of thousands of people at once. Like, there's so much to it. So it reminded me it's just a scratch outside the scope of QED. And QED itself at the time was going to sort of really refocus on the sort of core banking side of fintech. So parted ways in early 2017 on what I think are very good terms. Launched another conference with Jay focused on impact of technology on the workplace, future of work, things like that. And in the course of doing that, got to know a couple guys who were launching a new boutique VC fund that really reminded me of a lot of the best of QED in its early days, focused on just that topic. What I like to call, any startup that's trying to drive the success of employers or their employees. Like, that's in scope for this fund, SemperVirens, that these guys were launching, and got to know them. And, I sort of first became an investor, broke my own rules and made a small investment, then became an advisor, then joined their investment committee, then early 2020 with Fund 2, became a general partner in the fund. So now that's most of what I do, and I'm not, making a nuisance of myself generally.
Yeah. I mean, it's there's so much connectivity between the workplace with between banking and insurance. Of course, the entire dang insurance industry spun out of loan contracts 3,000 years ago. So I mean, like it's they've been connected at the hip for millennia, literally.
Yeah, I mean, I will admit truth is, I know very little about almost everything. I know a little bit about some things, but I've got a decent appetite to like learn more. Whether I can use it directly or not, I like learning. And so, my partners are much more knowledgeable about things like brokers, especially like benefits brokers. They're much more knowledgeable about things like health insurance, right? So I'm getting the chance to actually, hopefully make a little contribution on the venture side and on the InsureTech and FinTech side for the firm. But I'm also sucking in as much knowledge as I can, just about like, okay, how does this part of the world work? And then what can that tell me about other parts that I thought I knew about a bunch about, that maybe like I can unlock some new ideas there too.
Yeah. It's really challenging even just inside of insurance to get your head around everything. Because as soon as you think and Rob and I have talked about this a bunch, but as soon as you think you know a corner of this industry, you get your mind blown. And you think you understand what policy administration is. I mean, something pretty fundamental to insurance, right, is policies. And you start diving down the rabbit hole and you go, I don't know enough. Then you talk to, 3 policy administrators, and then you say, okay, well, I've got to understand underwriting if I understand policy, and then I got to understand billing and portals, and then I got to understand. These are really fundamental parts of like how the insurance industry works, not just technology. And it's a limitless pit, and that's just commercial insurance. You go to health, life, disability, then you go to you go to workplace tech, like you're doing with Ladder, Human Interest, Pinwheel, Clio, Spring Health, Carrot, Healthcare Tech. I mean, these each one of these is probably a 5-year rabbit hole you could just dive down and to try to understand the problem they're solving.
And look, that's why I'm a VC and not a founder, right? Like I'm not diving so deep in that I actually understand anything. But that's not my job. Like actually, and my partners paid me a good compliment, right? I think they actually figured out what might be the thing I'm good at. If there's anything, right? This would be it. They pointed out that I've got really good timing. Like, oh, you went and joined Capital One at 1,200 employees at a time where like the credit card industry was growing, in part because the technology to enable it to do things in more than just you walk into a branch and if they like how you look, then you get a credit card. Like that was pretty good timing, it turns out. Okay, fine, score 1 on that. And then, launching a venture capital firm with a heavy emphasis on fintech in 2008. Actually, really good timing. Like in hindsight now, we know, oh yeah, that was like the golden age of fintech was from the financial crisis, maybe to, COVID, we'll see. But like that was, pretty good timing. And obviously, I knew it at the time. At the time we were doing that. Oh yeah, of course, that's the right decision to make. And then, launch an InsureTech conference in 2016, right? Well, okay, that's probably decent timing there. And then, start getting involved in this future work thing around 2019 or so. Yeah, it turns out future work started to become a prominent board level issue around 2020. I don't know why, something about COVID. So I think, whether it's better to be lucky or smart, right? I feel like I've got good timing at least. And
about a little bit of both, right?
A little bit of both is okay. But it also means like I'm pretty good at picking out, when sort of big inflection points, right? Almost more macro trend on these things than micro trend. I'm okay on the micro, but I think probably my best public prediction at least that I've gone on record about was like, around 2016, 2017, saying, the API-ification of insurance. Like, now that was just if you spent a decade in what was going on in fintech and banking. It's like, of course, insurance is going to follow that 5 to 8 years later, and that's one of the big moves. And But like, I sort of feel like when I said it at the time, most insurance folks said, well, first they said, what's an API? But then they said, why do you think that's actually going to like matter? And I think that, that's what I'm probably proud of sort of going on record for.
Yeah, absolutely. We're going to talk a little bit more about investments later and how people fund innovation and get started. We're going to talk about bootstrapping versus venture capital and and everything down that path. I think we had some other questions too, and I'll let Rob go, and then we'll circle back around to venture capital. Rob?
Yeah, James, I think just teeing up that dialogue, Caribou, one typical question we ask every guest is to allow our audience to have a little bit of a window into your life, kind of what does a week in the life of Caribou Honig look like? And in particular, you kind of mentioned that balance between you're not going to be really down in the weeds, right, down in the dirt on some things, but yet having that macro view. And I do find it, there's a balance there, right, in terms of like having enough insight where, you may not see the individual pieces, but you start to see the mosaic, and then really just fluff, right? Just kind of, I saw somebody the other day put on Twitter, there's a reason that I don't pay for free advice because it's worth, what I spend on it. So sometimes I struggle with that dichotomy, right? It's like, as somebody that wrote a book on insurance, I have gotten so many questions since the end of insurance come out that are very domain specific that I feel wholly inadequate on answering. I feel bad about that. So just kind of curious, so many people know you from so many different aspects of your life. Give us a picture of, I guess, the full Caribou Honig and profile, if you will.
Yeah, so let's start with expectation setting. It's damn boring, right? I'm not an interesting person, that's for sure. If you ask my kids now, 19 and 21, what I do, what a week in the life looks like, they would say, well, I'm pretty sure, Dad, that you play World of Warcraft for half the day. That's as far as they can tell. Must be it, right? Most of my days start in the morning with walking the dogs, and they end in the evening with walking the dogs. That's part of the real day in the life too. Although actually, some of my favorite parts of the day are where I'm walking the dogs, throw on the AirPods, and I give Jay a call and say, "Hey, what's up? What's going on with the latest conference you're doing? How can I help?" But that actually is a very satisfying part of my day. Talking to entrepreneurs, right? That is core in the life of being a VC. And yesterday morning, I started out my week, trying to come back from Belize here, and I trying to ramp myself up back into the cold reality of life. And I'm talking to one of our portfolio companies, CEO, and just sort of regular monthly connection on, okay, what's going on? How's the business? How are you thinking about fundraising? Are there any introductions that I or my partners can make? How can we be helpful? And then, I'm ending the week talking actually to a couple insurance carriers as prospective investors in SemperVirens, right? Always got to be fundraising when you're in venture capital, right? You're not just writing the checks, you're also seeking the checks. And I think that the things we do are actually a really nice fit for certain insurance carriers as strategic investors. So having some of those conversations as well. And, look, I can't get away from emails. Would love to get away from it. But I mean, actually, I say that I actually like well thought out emails. I spent probably 30 minutes today. This is the reality stuff. Like one of the CEOs that I'm involved with, he was asking about, hey, you've talked about horizontal accounting. What does that mean? Right. And can you give me an examples of it? Or how does this work? What does it look like? And so the easiest thing was just, okay, look, I'll whip up on a spreadsheet, an illustrative horizontal accounting. Here's kind of what I mean. Right. I could say 1,000 words, but one spreadsheet speaks more than 1,000 words, as the old saying goes. And then, I try to be really thoughtful about explaining what the spreadsheet meant so he could understand it. And I'm happy to talk to him about it too, but sometimes having a little prose to help there. And I don't think it was the kind of thing that ChatGPT could necessarily, that's a good, after this, I'm going to.
That would be a good prompt for it. I've been prompting it with all kinds of things. So, yeah.
Explain horizontal accounting. That was actually good thought work because I feel like I'm helping the CEO and using one of the few things I actually know about to be able to help him. So that's kind of my week.
Yeah, awesome. So let's dive into funding and venture capital. I'm a 22-year bootstrapped entrepreneur. Started with $5,000 in my dorm room in 2001. Today I've got 280 employees, and we've had an exit. We've built product. We have three companies. we had 4, sold one of them. So I've been through the life cycle of a bootstrapped entrepreneur. I'm now an LP at some VC funds, and am enjoying the insight and the different perspective that gives. It appears that the growth at all costs model is changing, and it needs to. It's needed to for some time. Let's talk about growth at all costs, greater fool theory, because a lot of growth at all costs was predicated on greater fool theory, that you could offload a company. You would dump massive amounts of cash into spending at a company, ramp revenue without worrying about the ability to be profitable, and then dump it or exit before you had to prove you could be profitable. And hopefully whoever bought you, would be able to bury it in their financials or figure out the profitability model. How has the funding environment changed now with a much stodgier public market not willing to underwrite massive losses and companies that can't make money?
Look, for the most part, I'm a big fan of the pullback in valuations, including public market value. Like it was silly math, right? And gosh, easy for you to say that now, Caribou. But it was kind of silly math. And I think what we're seeing is a reckoning on 2 dimensions. And one doesn't bother me at all. One is sort of a different character. So valuations, right? Like valuation, don't think about, that's $1 billion or $2 billion or 200 million, right? Think about it in terms of valuation multiples, right? Oh, are you paying 5x revenue or 10x revenue or 50x revenue, right? Okay, look, if you are getting 50x revenue, right, and not off of $5, off of $5 million or something, all right, you were very good at selling and somewhat lucky, very lucky with timing, but that doesn't mean that was like a legitimate valuation connected to your fundamentals, right?
Yeah.
And so, we've now seen a reversion to something much more historic kind of revenue multiples. Arguably, the pendulum has swung farther. The pendulum, you see a couple of these cycles, the pendulum goes back and forth and back and forth on this. But look, that's a valuation multiple question. And we can start to build some sensible ranges around that. I don't have any blame or any sympathy for the founders who raised money at really high valuations or really high multiples, as long as they recognize that they were boxing themselves in a little bit and might have to take money at a lower valuation, something like that. If they took too much money, that actually does start to cause some second order issues for them. And entrepreneurs, you tend to to architect your business to the capital you've got. And so that which takes me to the second aspect, which is much more pernicious if it's in a company, which is if you've got lousy unit economics. I mean, look, we are in many ways products of our early training, right? My early training was at Capital One, right? We were very rigorous in thinking about the unit economics. And we would look at competitor products, and we would try to reverse engineer their NPV model. And there were lots of instances where we can't actually understand how they're going to make money on that product with our assumptions that we know about, even for their business. We don't think they can make money. And lo and behold, a couple of years later, they blow up. All right, +1 for rational economics.
But when rational economics apply, yeah.
Well, actually, I hate competing with an irrational competitor.
As do I, because it's extremely challenging. And when they have irrational investors behind them who are willing to foot a 4 or 5 year bill with a rational unit economics, it's very, very difficult competing against that.
I mean, competing against dumb competitors, great. Competing against smart competitors, fine. But competing against irrational competitors, those who are running negative economics and don't even realize it. Right. Because you just got to sort of hold on for a while. But then,
it's greater fool. Yeah. Someone else has to come along and bail them out. But they assume it's going to happen.
Yeah.
Right. I mean, they get high on their own supply.
My days at QED were also formative from a venture investing perspective, because first off, we weren't a big fund, right? We started with like a $30 million pool of capital, right? And the basic premise was, for as far out as we could see, we were going to take no additional capital. That 30 million was it. So if we were going to do follow-ons, right? Yeah. Great, right? But it's got to outcompete writing a new check into some other company. There was no real distinction that meant much between Fund 1, Fund 2, Fund 3, right? Because if you're going to write a check into fund 2, it just means you're not writing it into a follow-on in fund 1. Right? One common pool of capital. So capital efficiency, when we were looking at startups to invest in, was actually really important. Right? Partly because we certainly did not have the deep pockets to like keep throwing money at them, but also just like if we're going to get a good return, not terribly diluted, right, you needed the capital efficiency. So it's no surprise that like our biggest winner from Fund 1 was this little company called Credit Karma. Right? That was also very focused on unit economics and rational sort of, if I spend $1, promoting the fact that you can get a truly free credit score from me, right? Then does that actually generate the customers that I can then offer really good, appropriate credit products and get paid my cut when they take it? Like that was our kind of business, like capital efficient and rational and a great value proposition. It was actually elegant, right? A great value proposition for the consumer, right? Because back then, like in practice, you had to pay this subscription to freecreditreport.com. That wasn't actually free. It was also elegant because it served the lenders really well, right? It actually brought them applications from people who were kind of appropriate for the product that the lender was offering and for the underwriting policy. Like that made sense.
Yeah.
So, we really liked businesses that made sense and as a consequence could be capital efficient.
So let's talk about that as it plays out, right? And you look at capital efficient businesses or businesses that have the ability to actually add value. And let's look at the current InsureTech market, because there are some highly irrational valuations. People's rounds, and they knew they knew the winner was coming at some point, and so they started raising some pretty large rounds to get them through 2, 3, 4 years of runway. So you could argue that like right now we're like a year into everyone's round and they're not going to want to raise again right now because they don't want to take a down round or write down the valuation, right?
Yeah, but they didn't. I'll push back against that a little bit, James. I don't think they actually raised 3 or 4 years of runway.
You don't think they knew the winner was coming?
Because so one of
many of them say they did.
Yeah, one of the foundational principles here is entrepreneurs will architect their business model to the capital they've got.
Yeah,
right. And we saw that years ago, actually, with some of the mega SoftBank rounds, right, and then the mega Tiger rounds that would come in. And I'm not referring specifically to InsureTech or even to FinTech. You would see these companies that, I'm raising $50 million, and SoftBank says, well, that's not enough. How would you spend $250 if you had it?
Yeah.
Well, an entrepreneur is going to take that bait often and figure out ways to spend it. They're going to and some of it will be ring fenced into G&A, but a lot of it will actually go into sort of the gross margin structure and architecting the business in a way that is often not healthy. And so, on my old plan that would have given me 4 years of runway, but now that I got the money and money looks cheap for a while, and I'm being pushed by this new investor to grow sort of hyper fast, right, at all costs. Well, maybe I gotta accelerate my burn. I still have 2 years of runway. That's fine. Problem is when the music stops, right? They've got a sort of unit economic architecture that just isn't all that efficient necessarily because they architected for all that capital.
But we're seeing this happen, right? The prices were too low. We have some InsureTechs who underpriced their products. They went to market with underpriced products, and some irrationally underpriced, some intentionally underpriced, some just screwed up the math. I mean, I think you kind of fall into all three buckets, and they have really bad loss ratios, really bad, and it is the game over for them. Because if they to get to where they have to be break even, right? Like they're just to tread water, they'd have to increase prices so much that they would lose most of their business, right? Like a slick way of getting a quote bind and pay doesn't help when you've got to increase your renewals by 25% to stay afloat as a company. People will bail over rate. Even though you have an easy user experience, right? So is it the over?
I'll start by speaking mostly in generalities. Mostly,
I was trying to speak in generalities without speaking about a specific company.
Well, look, there's a company I know in particular. Prior investment went public last year, and last I checked, market cap around $1 billion, maybe $1.2 billion, on like $400 million of revenue, growing 40% year over year, and not quite break even, but not that far off, burning maybe a couple tens of millions, right? But not burning 60 or 80 million a year. Like, fine.
The losses aren't accelerating. Yeah.
Yeah. So like, what gives with, like, why is this company getting a 3x revenue run rate when it's growing 40% and has pretty good gross margins and so on? And my simple man's view is what's going on there is I know 3x revenue run rate is the wrong multiple. I know that for an absolute certainty. It should either be in the ballpark of 10x, long-term historical kind of stuff, or totally reasonable that maybe it should be 0x. Maybe it's not going to make it. There's some deep flaw in it. It's hard to tell, from afar. So maybe it should be 0x. Maybe it should be 10x. I just know it can't be 3x in the long run as the right answer. Of course, 3x is coming out as the sort of probabilistic weighted average that the market's giving it because the market can't figure out, is this a long-term sustainable, healthy, high growth business? Oh yeah, 10x. Or is it sort of deeply flawed fundamentals and kind of going out of business, 0x? That's the debate. And so as the answer to that won't be a mystery forever.
No.
Right. Whether it takes a few quarters or a few years, that will get revealed. Because if it's fundamentally flawed, right, that's going to show up at some point here in quarters or a couple years at most. And if it keeps growing and scales and the gross margins, right, like I say, are actually quite good. So as the gross margin at times scale starts to overwhelm the G&A, like, oh yeah, you do start to generate some cash there and profitability. So we're going to see these split. Now, so that's at a public company, $1 billion, give or take, market cap. Then you look at the companies where it's maybe now $100 million market cap, right? And I don't have to name names, right? But you look at those, and they're burning like 10, 15 million a quarter, right? And it's basically like they're almost, as far as I can tell, they're kind of boxed out of raising capital, right? Because they're public, and so to raise capital is a different ballgame there. Raising capital at the $100 million valuation, right, is going to cause all sorts of second order issues as well. And they're not necessarily, and they're not growing anymore either. So they're not really, fitting that kind of mold. So I don't know how they escape the gravity well that they're falling into.
I don't think they have enough fuel to escape. That's the real question for me. Is we're talking about the ability for these companies to actually become profitable before they run out of cash, or become break even, because you're not going to fund accelerating losses, and especially when the core fundamentals, their core loss ratios don't look good. And it's really interesting to me on certainly what's happening. And valuation multiples needed to come back down to earth a little bit. So this is a necessary and good correction, and certainly financial discipline is a good thing as well. Rob, I know you've got an angle on this.
Yeah, well, so I'm curious. I would love to hear from both of you, right? Because James, I mean, that story about, right, kind of bootstrapping, starting your dorm room in 2001, and I don't know if that time, if you looked into VC money or not, but there's a couple factors at play here from my perspective, and Caribou would love your thoughts on this in terms of just the growth of VC in general. Like, to me, this was kind of a Silicon Valley phenomenon. It wasn't, I was very focused on the public market. I started my early career at the Federal Reserve. We had a lot of alums that went down to Richmond and Cap One. So definitely familiar with that move. And, over time, right, like it feels like VCs are everywhere. People are going public markets less, or they're going to be a lot more mature because of all the regulatory standards, whatnot. And there's been a push, not just, in like New York and Silicon Valley, but people are looking for investment opportunities all over the US. all over the world. You mentioned the limited partners, Caribou. I know I've been on the both, work with folks when I was at USA and the corporate venture side. When I was at AF Group, and we partnered with a VC that we were a limited partner with. So I've been on that side of it as a partner, not necessarily in the VC world as well, but I've just, you have kind of the phenomena of more and more funding, right, becoming available, particularly through limited partners, and just everyone's trying to get, in on the action in some ways. And then this like historic near zero interest rate, right, landscape for an entire decade following the great financial crisis. Well, now, right, inflation and the rise in interest rates, we're seeing that. I don't know if the supply of venture capital is also, if the taps are turning off, just in terms of like the amount of money you're able to raise and others, right, from limited partners, or if it's simply just a cost of capital phenomena. So maybe you could just like, if I'm thinking about, if I'm a founder out there and I'm trying to make this decision between going the bootstrap way or maybe looking to raise funding, knowing that the environment isn't what it was, right, 18 to 24 months ago, maybe you can just help with what is the VC landscape today. And then, if you've got some entrepreneurs out there, some founders that are trying to figure out how to position their new startup, if you guys have any advice for them.
Yeah, there's a couple questions in there, Rob, to unpack.
Sorry,
so I'll try not to sort of go.
No, questions at once.
They're all great questions. I'm just not sure which one to tackle first. So I'll break it basically. I mean, yes, is the funding environment for venture capital, like for firms like SemperVirens, is it a tougher environment to raise new funds? For sure. It's definitely a tougher environment than it was a year ago. It's not an impossible environment. And, especially we've got a pretty healthy track record and a really differentiated sort of reason why we think we deserve to exist. And that's resonating. But, it's still a lot tougher market than it was a year and a half ago. Now, for the entrepreneurs out there, right, you're really asking two questions, like, should I and can I? Right? Can I raise venture capital? Right. Well, look, simple rules of thumb here. Like a year and a half ago, can you? Do you breathe? Great, you can raise venture capital. Maybe you should or shouldn't, but can you breathe? Great.
Sure.
I'm exaggerating a little. Today, like great companies with great profiles are still getting funded and getting funded at healthy valuation. What makes for great? Again, sort of checklist for the entrepreneurs out there. Are you growing 3x plus year over year? Check. Right. Do you have healthy gross margins? Right. Now, healthy can depend a little bit. Are you truly a software company? Are you tech enabled? If you're running 80% gross margins, yippee. If you're tech enabled and you're running 40, 50% gross margins, that's still really solid. Right. That says that you're doing something with some pricing power. That's great. If you got 30% gross margin, you're probably not a fit for today's venture capital market. And then, essentially, how much capital do you actually consume, right, in order to get to your destination, right? If you're very capital consumptive, okay, that may make some VCs nervous now. If you have a fair bit of capital efficiency, right, then that's important, right? So those companies are getting funded, right? High gross margin, high growth rate, decent capital efficiency. If you're sort of 2x to 3x growth, middling gross margin, consuming a fair bit of capital, maybe if your top line growth is below 2x, if your gross margins are below 30-40%, right? If you're very capital consumptive, no, you probably can't raise venture capital, absent some very special circumstances. So let's say you can raise venture capital, right? Maybe you're at the 2.5x growth or above. You got good gross margins and they're improving, and so on. Doesn't mean you should. And I think it's really the nerdiest way I have to put it, but it's actually like probably the closest to truth and beauty, is that when a VC is writing a check, and I'm thinking sort of mid to early stage VC, not like late growth of capital, they are expecting at least 40% rate of return on that check. Now, they know that some of the companies will give them 0% or negative 100%, and some will give hopefully 80, 90% rate of return on that. But, expected value, what they are building their case around, even if they don't say it this way, is basically 40% IRR. So if you as an entrepreneur say, okay, if I get some incremental money into my business, I think I can get it to return 25% rate of return. you should not raise venture capital. You shouldn't be able to, but you should not, even if someone offers it to you, because they will be disappointed, right, if you deliver what you think you can. And that's a recipe for all sorts of pain and suffering. And you may lose a lot more of your company and more control of it than you thought you would, right? Even though you deliver that 25% IRR. Because the VC will structure the terms often, right, to sort of plan around that 40%. If you say, if you give me $1 million, VC, I believe actuarially that I can put that into a money machine, right, and generate $1.60, right, back at you in a year. Like, all right, that's a good use of venture capital because it's above the underlying hurdle, right? And if you deliver, then your VC will be happy and you will be happy because you'll be generating excess value, right, in the course of that. Now, I'm sure a finance professor could tear apart some technical aspects of what I'm saying here, but like that's the sort of underlying thing. Like, do you really have that kind of use of proceeds, right, where you actually believe as the entrepreneur that you're going to generate in excess of 40% rate of return on that? And if the answer is no, then you shouldn't. Now, even if the answer is yes, then it's still a question of, do you need it? Right? What's the delta there? Because you do give up some elements of control. You do give up some of the upside almost by definition. Right? And that's sort of getting back to this question, well, if you can grow it at 60, 70, 80% IRR on using that capital, then actually the theory is you can grow the pie bigger, faster, right, by having that capital rather than not. But look, I love capital efficiency, and I really respect entrepreneurs that can bootstrap basically all the way through up until the point where, the company is worth hundreds of millions of dollars because because the scale of it is so big, at which point it's really just, raising capital opportunistically because it's cheap, right? If the company is worth $300 million by the time I'm raising my first VC money, so to speak, I can take in $30 million and it only costs me 10% of the company. All right. Then you probably should when you can.
Yeah. Yeah. Awesome. Really good advice. And honestly, I think it's a much better explanation of when you should and shouldn't raise money than anything I've read in a textbook. It's really about IRR and if you can hit above or below the expectation, because certainly in the funds that I'm in, they have pretty high expectations of internal rate of return for the money. And, otherwise you just go to the public markets or you'd go to, fixed income gets a good return right now. And you can plant your money in treasuries right now and make 4.5% with no downside risk whatsoever. And so there's a lot of places that investors can make sure money. All right, we have to wrap, but I'm going to do some rapid fire questions. All right, Caribou, are you ready? Can you hold on to your hat? Hold on to your hat.
I'm ready. All right, I'll tighten the hat. We're good.
So we're going to do there's a couple of rapid fire questions to close out, and I am going to ask your opinion on things, and it's okay to pick one and not worry about offending anybody else. Okay, so. First, your favorite portfolio company.
Oh, that is mean. So I'm really partial to a company called CoverGo, which is a provider of no code for the insurance industry. A part of what I really like about it is that it's probably our most international company. It's actually based in Hong Kong, but it's expanding into the US, but it's got customers in like 5 continents now, which is stunning to me.
Awesome.
CoverGo.
Next one, favorite topic, not individual speech, but favorite topic at ITC right now, like the topic that just jazzes you.
Ooh, that's a good one. I do like embedded insurance.
Nice.
But the problem is everyone likes embedded insurance. So that's too much of a cop-out.
That's okay. It's your answer.
I like invisible insurance as a topic, which no one is talking about.
In other words, bundling it in with the products, so there's not
so embedded that you're not even allowed to opt out. So we start to lose sight of it. Like your car warranty, if you buy a new Ford, right, you can't tell the dealer, "Oh, I will. If you take $500 off of it, I will promise I'll sign a contract and not do any warranties." Nope, you can't do it. If you go to the doctor and say, "Okay, I'll waive my right to sue you for malpractice if you take $50 off the bill," which is probably how much it costs for your malpractice insurance pro rata. Like they'll say, "I'd love to, but no, I can't." Right? You have to buy malpractice insurance implicitly, invisibly when you go to the doctor. Like that's interesting.
Next, favorite event that is not ITC.
Blueprint.
Yeah, I figured you're going to say Blueprint. So
I got so many. Like, Blueprint.
Yeah.
Look, it's the ITC of prop tech. Right?
Yeah, so. It's a good event too. We went to Blueprint last year.
Oh, awesome.
Favorite technology you're playing with right now?
I mean, okay, ChatGPT is fun. Yeah, and so I've got to ask it, like, explain horizontal accounting and see if it knows that. Like that. Yeah. That'll be my next thing here.
Favorite non-insurance podcast?
Ooh, if I said I don't listen to podcasts, then you're probably going to be mean at me.
Bad. You'd be a naughty boy. Mine is Hardcore History by Dan Carlin.
Ooh,
it's just an amazing history podcast.
I listen to the occasional NPR. How about that?
Fair enough. Best book you've read recently?
It was about 2 or 3 years ago, but it sticks with me to the point where I think I want to reread it. Is the 3 Body Problem series.
Okay, awesome.
If you've not read that,
I have not.
It's Chinese. My Mandarin is a little bit rusty, so I read the translation. The first 50 pages, really hard to get through. It's like, what's going on here? And then it's like, oh my gosh. And so the 3 Body Problem, which is a trilogy, is just amazing. And my wife loves it, and one of my sons read it and loves it so.
And lastly, since you're fresh back from Belize, other than Belize, your favorite vacation spot?
I would have said Santa Fe, Taos, northern New Mexico. I will now say St. John in the U.S. Virgin Islands.
Oh, yeah.
And the reason I say that instead of Santa Fe, northern New Mexico, is because 6 months ago, we relocated and moved to Santa Fe, northern New Mexico. So it's no longer a vacation spot. It's where I live.
It's home. That's great. Well, St. John's great. 2/3 of the island's a national park, and it's super chill. I love it. That was my first place I ever gave a speech 400 speeches ago was at St. Thomas, St. Croix, St. John. I went around the islands and gave speeches there in 2005. So it's been a while.
Wow.
Been a while. It's awesome. Well, Caribou, it's always great having you on the show. It's great talking to you. I'm excited about what you're up to, and I really appreciate you being on.
Well, thanks so much. Really enjoyed this.
Yeah. Rob, always good to see you, brother.
Absolutely. Great to see you again, James. Caribou, great to see you as well. Thanks for being on.
And thank you for tuning in today to geek out for our interview with Caribou Honig from InsureTech Connect and SemperVirens. Again, this has been the InsureTech Geek Podcast powered by JB Knowledge, jbknowledge.com. It's all about technology that's transforming and disrupting the insurance world. I've been your host, James Benham. That's jamesbenham.com, with co-host Rob Galbraith at endofinsurance.com. Thanks to Jim Greenlee, our podcast producer, Kara Dalton-Aro, our creative producer, and thank you for joining us today. Look forward to talking with you soon. We're taking you on a journey through insurance tech, so enjoy the ride and geek out.